zero race forward rates and zero coupon yield curves. Finally, we will do some interesting calculation, not just sitting here. And, because Appendix B contains many things. And from last week, we can see that, okay, what kind of discrete and continuous functions can we identify. So let's start to build up some stuff like this. So let's first let's build a discrete future value, then let's build up a continuous futures value, and after that we will use this because after that we will start to emulate some bonds and start to see that what happens there. So, risk management lecture second. Let's say B part. Okay, it had a complicated name, so zero race forward race, zero race, and so on. So continuous compounding. Yeah, so I would like to have a discrete position and a continuous position. And right now let's just build up. So let's say that the underlying cash flow is 100 and are, let's say, 10%, oh sorry, 0.1%, and it's really stupid, so I don't want to write it this way. Then we need time, which equals 1 in a year, and should we cut it to m pieces? Yes, let's cut it. So let's say first we are just using 1. Payments in a year. Percentage, yeah. Okay, so in the case of a discrete scenario, then the future value will be C multiplied 1 plus divided by m, and on t multiplied by m. I always prefer to use brackets because I know it will be preferred. Just have we done this? Okay, we have future value, and of course we can have a function for that in Matlab. So as well. So if someone don't want to remember on this really difficult equation, so rate is thing is r, number of period is m, payment is c, present value and u. Initial is 0, okay. And payments are due to made end of period. If you, yes, okay. What? How can I? Oh, yes. No. I'm 30. But you should be bigger. Why are you not bigger? Periodic interest rate as decimal fraction. Yeah, we use this. Number of periods. Periodic payments. Let's check the tutorial. Is that at the end of each month? Okay, so now we were able to emulate something like this. And in the continuous case, we can just use the Euler number, because in this case I think we can use just the E. No, not E, X. Yeah, EXP. So now we can see that. So in the case of discrete payments, so this is the realistic thing, because we are not able to pay continuously, but from modeling point of view, continuous payment, it's easier to capture, and that's why there is a difference between the two approaches, and this is what this curve is trying to describe. So what is happening if we are providing not just one payment in a year, but 12 payments in a year? Then in this case, the continuous payment and the discrete payment will be closer and closer to each other. So if I'm just changing it to 12 payments, and suddenly it starts to increase and become close to each other. But if I'm saying that we got payments every time of the year, 105. Yeah, it's still smaller than just 3-digit smaller than the continuous. So that's why we are using continuous, because from modeling point of view, it's easier. But yeah, we should not forget that. This is just from modeling point of view. Okay, so from now on, we always will use the zero curve. So practically we are always using zero curve, just we are never calling it a zero curve because in this case everything is calculated back to today. So starts today, lasts for n time periods, let's say n years or n months, and all interest and principal is realized in these cases. So whenever we are collecting data, so I'm going back to my asset class, fixed income bond, government bond database, let's say France, because we like France so much due to the case study, and curves, and there is already government zero rate. So we are always using this thing here, just practically we are never defining. So the entire Madura book was completely living without defining that all the interest rates are zero rates in this case, but yeah. In the case of forward rate, we can just take the expected interest rates in the future and we are just implying from the today's zero rate. So if this is the zero rate in maturity for maturity in I years and this is the zero rate for maturity in K years, then practically we can calculate the forward rate by just using an interpolation between them. So let's say that forward rate. I'm going in the wrong direction. So zero rate for maturity, let's say 3 years, and 4 years. Let's say 5 years, and in this case we can check what is the actual case. 5. Okay, so oh, come on, it's going down. Yeah, because I was able to pick from this one because they are expecting the short-term decrease in the inflation. Terrible. So let's take the... What happens if I'm copying this one to Matlab? I mean, what is the level of failure and misery? Looks ugly. Okay, so 5 minus 3. And I think it would be wise to divide it by 100 because otherwise it will... it doesn't matter that you are dividing it or not. So 2.889 must be the forward rate. And it's not. It's so we could see that we can find the mispricing on the market right now because this thing is different from this thing. So last 2 digits are not perfect. Okay, lessons learned. Then bond pricing, which is much more interesting for us. So in this case, we have to define the present value of the cash flows. So how can we do this? And there can be many different ways, but the most beautiful one is when we are using the financial instruments toolbox, and in this case we can build up bond pricing with easy steps. So if you are opening the PowerPoint, okay, we can just copy everything. It's not continuous compounding now, it's bond pricing. And you can see that it's already prepared because we can price fixed bond and also we can price floating, pricing floating bonds with that one. So if you are switching back and forth or changing the function here, then you can do it easily. Then we have also a maturity function which determines that, okay, what is the expiry time. So let's say that it should expire. Right, let's calibrate that base 22 and just let's add 5 years. Okay, coupon rate. In this case we have to be really careful because if it's a floating rate, then it will be a spread. So the LIBOR plus spread will be used. If it's a fixed bond, then the coupon rate functions must be copied here. So this is this matters. So the coupon rate we are going ahead by 5 years. Let's say it's 4. It's above the government bond, or the zero curve right now. Okay, period of payments. Let's say it's 1. So if it's a floating, then it's a reset time, it's a period in the case of fixed rate, but let's say it's 1. Basis is also 1, principal is 100, and it's a fixed bond instrument. And you can ask the question that, okay, but can we change it somehow? So unfortunately, if we are opening the fin instrument function here and I'm not able to zoom in, then you cannot see. Yeah, you can see it, okay, whatever. So you can see that deposits, the FRA is the forward rate, fixed bond, float bond, fixed bond option, option embedded fixed bond, swap, cap, floor, swaption, and also you can see that not just vanilla but also loopback barrier, Asian and spread switches can be used. And also later on when we will working with the CDSs, then we will also use this. So this function will provide just a general setup for the data set. So if we are executing this one, this is calculating nothing at all. This is just preparing the data. Oh my god, now I can see what I was changing. Finally, I have big values here. Just so if we are clicking into bond fix, this one is bigger, and also this one is bigger. At least now it's visible what I'm doing. Then you can see here that the bond fix, which was the output of this function, is just a collection of the input data. So it's just organizing because it's good for itself, but otherwise it doesn't matter. And the similar things will happen in the second and third step. And the overall pricing and the calculation will just happen in the fourth one. So until we are just preparing the inputs again and again. So yeah, settle time. This is when we have to provide the time today. So let's give today's time. And this is when we have the zero rates. Practically, zero rates will be everywhere. So it doesn't matter that we are pricing in a swap contract, we are pricing in an option. Zero rates will be always required. So it's and also we can provide months, and also we can provide different years. So this month it will be recalculated by the Matlab, so it doesn't matter, but we have to give the following data. And also we have to be really careful because sometimes we have to divide it by 100, sometimes it's not necessary. So right now it's not necessary, but you will see when we are going forward during the semester that sometimes we get really strange numbers if we are not doing that. Okay, so 3 months. I'm just copying them to make it right. 1, 2, 3. It would be so nice if we would have a huge download it in Excel button right here, but they don't have it. They are not paying enough money. Five. 7. 10. Obviously you can increase the density or so you can add more years, but I'm lazy, so. And I already have to copy and paste everything, so yeah. And also we can see that it's much more curvy, so most of the things and volatility is always happening at the shorter time period, so so that's why it's easier to say that let's represent the short-term points much more, and after that longer maturities can be less important or less relevant. Okay. After that we just have to execute this thing, so no further changes are necessary because the setter date and the 0 times will be added together in a mysterious way, and after that the rate curve function will organize only. If the inputs are not in an appropriate form, then the rate curve will not operate at all, but otherwise. So my RC So you can see that all the inputs, and it's really cute because the date is provided. But sometimes they are requiring completely different date formats. So I don't know, maybe there were multiple developer teams, and sometimes you have to use this date format, sometimes you are not using this kind of date format. So, or maybe we could, yeah, obviously if we are scripting enough, then we can convert everything to the same level, just it doesn't work. Yeah, and after that, there is the fin pricer. First of all, let's check the fin pricer, because it's also quite a general function, so it's not just created for only for this task. That's the benefit of the financial toolbox, but pricer type. So it can, right now we are using it for this counting, but it can be, what is the IR tree? Wow. Okay, something. Uh, okay, this way. With this whole white will be during option calculation. This is also during option pricing, because I was able to see this one. And this is when we can have the different option pricing equations. So black source. Where is Heston? Okay, so somewhere. But as you can see, there are many multiple pricing methods. And and also CDS pricing can be there. And why can't I see? Whatever. So we will work with it later also. Okay, and after that pricing. Yeah. Ah, okay, I did not execute it, just I was talking about, sorry. Yay, and after that, we have the price of this beautiful bond here. So. And of course we can do the same thing with the floating bond. So it's, let's say A. Fixed bond pricing, and now let's copy everything and paste it here. Floating bond pricing. And now we have to just overwrite. Float bond, date time remains. Instead of coupon rate, now we have a spread. Instead of period, now we have reset. Let's keep it still one, so once in a year we are doing something, otherwise not. Principle same. Float bond instrument. And we just have to recalibrate this part. So Okay, we should not rename this because it doesn't matter that what is the variable name, so it should be float, but who cares? After that, settle date is the same, and the rest of it's also same. So that's the benefit of this kind of function usage.